Let's start with that oil price, because I'm sure that's something that's been top of mind for many investors this week. We had it almost spiking to $120 yesterday. It's come back a little bit today, so about $112 this afternoon. We have had news that Saudi could step into the breach. Also some rumors that Muammar Gaddafi may have been shot in Libya. But perhaps from an investment perspective, if you're looking at the oil price at these levels, does that keep you awake at night?
Not really, because I think it's something that we have anticipated. I think without the crisis in the Middle East, we were bullish on most commodities anyway, including oil. I think what's happened now, it's been exacerbated by this instability in the Middle East and question marks surrounding supply that we may be seeing going forward. So perhaps it's a little higher than what we had anticipated. We were thinking around about $100 a barrel. We know the spike up to 120. I think we will see these kind of volatile movements in the oil price going forward, as long as we do see instability in the region, so which doesn't look like it's going to be ceasing very soon.
Okay, so it could be a temporary phenomenon though, and where would you see it settling then, looking at the demand outlook going forward?
I think what you will find is the longer the instability, the uncertainty is in the Middle East, the higher the oil price will go, because people will start buying contracts forward and perhaps anticipating some kind of supply squeeze that we saw in the mid-70s, which could be very negative for the world economy going forward. I think it's early days, but I do still anticipate a firmer oil price. And to answer your question, I don't see any reason why it shouldn't settle around about current levels after spiking higher.
Well, this was something that was brought up with our annual budget in Cape Town on Wednesday, just really looking at some of the risks to global growth and to South African growth going forward at this stage, because we are seeing a recovery, but it is shaky at best. Do you think this could impact the global economic recovery?
Certainly. We had always been, prior to the Middle East crisis, been a bit wary of a dip in the second and third quarter of this year. The oil price and the instability in the Middle East has certainly made that position even that much more tenuous. And one of the big problems that's likely to face us going forward is what we've been particularly worried about, and that's stagflation, where you start seeing growth levels tapering off, or in fact even dropping, and the effects of inflation coming through and on a global level. So I think the possibilities there are, stagflation is certainly not something that would encourage any kind of stock market growth at all.
I know you have mentioned stagflation before on this show. What sorts of policy response would you expect to see, though, from central banks around the globe if we do indeed see this stagflation coming through? Because it really puts them between a rock and a hard place, doesn't it?
Absolutely. I think they'd be reluctant to increase rates, and I think we'd find that at various degrees. In a country like Australia, where we did see them raising rates because of the higher growth levels and inflation, I think there'd be a few countries, they'd be in the minority, that would be increasing rates as they should be and keeping in step with inflation. But I would imagine from the European perspective, and if we look at the US, they'd be the laggards, and potentially that could pose an even greater problem for inflation going forward if they don't try and curtail that at the expense of growth. And that's the real problem. If they do raise rates, it's certainly going to prick a hole in the bubble of growth that we were hoping for going forward. An area like China, we do anticipate possibly higher rates or some kind of restrictions on the interest rate policy, but certainly not in the immediate future for Europe or the US.
I should imagine economies like the United Kingdom are particularly vulnerable to this, because we have very weak growth coming through in the UK, but we do have that inflation starting to shoot up.
Yes, and with the additional pressure that the UK and European countries of slashing their deficits or attempting to slash their deficits, that certainly does hinder any kind of growth going forward. Then we have the inflationary impact and then potentially higher rates. So these potential risks to the world economy have certainly increased a lot over the past month, and particularly because of the instability in the Middle East. In South Africa, we've got a slightly different story, where if we had a look at the budget, what was really encouraging was that we will definitely see spending carrying on. So we don't have a deficit problem really to speak of if we compare ourselves with the rest of the world. So I think on that basis we're looking pretty good. And in fact that translates into what we've been calling for, and that's a stronger rand relative to most other currencies. So I think South Africa, if you take a snapshot of where we are now and have a look at the country 6 months forward, I think we're going to be in much better economic condition than most other countries.
How does this all affect your approach to investments then, Kimon? Because if we do have that rand strengthening further from these levels, or even staying at current levels, many would say take your cash offshore. But then if those economies are looking vulnerable, would you want to take very much offshore?
No, absolutely not. I think I wouldn't be at my maximum anyway. I know that there has been an anticipation of a weaker rand going forward. We don't share that view. We believe that the rand will at worst be stable against the euro and sterling, and we actually think it's going to strengthen against the dollar. So I always look at asset liability matching, which is very important. If your liabilities are all in South Africa, there's very little reason for you to have exposure offshore. And if you do, then it should be purely speculative, and I would not encourage too much speculation with pension funds particularly. But if I look at the asset allocation, we've stayed at the same asset allocation as what we had 6 months ago, sorry. And we run about 50% in equities and favoring resources particularly, which we've seen a nice increase in. Looking at oil prices, food prices, we anticipate higher levels there. So we'll be looking for those kind of companies to be profitable. On the fixed income front, we're not really particularly fond of the bond market as such, and any bond exposure should be really in the short end of the yield curve. And I'm going to beat my drum, my favorite instrument that one should include in a portfolio. I'd be at full weighting on inflation-linked bonds, particularly with the type of scenario that we're forecasting going forward.
When you're talking full weighting to ILBs, what sort of percentage of your portfolio would that be?
Probably as high as 20%. But I do think asset allocation is really reflective of the underlying investors or beneficiaries from funds. So if I'm talking about 20%, it would be in my particular fund for my investors. But for me, 20% is a very nice level to have. I think all pension funds in particular should have exposure to inflation-linked bonds because they closely match the potential liabilities down the way. And it's the one instrument that really achieves your mandate, and that's to protect a portfolio against inflation. And that's really what we're always trying to do, get a real return on our investments.
Well, if you're protecting against inflation, would you also be including some gold in that portfolio? And what form of gold? Because if you expect the rand to remain strong, that's not going to be good for the new gold ETF here in South Africa. What sort of exposure would you have to gold?
I certainly have physical. I prefer physical because it has a dual purpose. I think it protects against the ravages of inflation as well as being an alternative currency. So it's actually nice to get some of your offshore exposure via gold, and your exposure to currencies offshore would be, because it's denominated in dollars, you'd effectively get your dollar exposure through gold, which I do think is going to increase in dollar terms.
Kimon, we have to leave it there. Thank you very much for your insights this afternoon.